Hello, welcome back to Weekly Market Recap. I'm with Rich.
Hello, everyone.
And I'm Knight. Let's get to it. So this past week, we saw the S&P down another 2.41%, brings us down year to date 15.58%. In the NASDAQ, we fell another 2.8%, which brings us down year to date 24.55%. And really, we've seen continuing this week just a ton of volatility. We had a couple days of down over 2%, a couple days of down even more. I think one day down even more than that, and then another day of up over 3%. So we just have been seeing these wild swings day after day. And again, what that means is a lot of the market is uncertain. There's a really good potential case that we do have a soft landing and we never fall into a recession, and then the stock market could recover rapidly. There's another really strong case that, wait a minute, we could be in a recession, we might fall into one. And so you have these two really plausible situations that are fighting against one another, and it leads to a lot of volatility. So speaking of volatility, let's look at what the market did this week. So we see, obviously, the first day a really steep fall. We saw it continue to fall, and then we actually had a big rise right before market opened on Wednesday. I think there was a real hope that the CPI reading was going to come out strong. We'll talk about that a little later, but the CPI actually missed, and we saw all massive sell-off that day. But then really, we did see a recovery most of Thursday. We ended up falling, giving most of that gain back, but still ending a little bit higher. And then Friday, we wound up having the best day of the week and recovering back to similar levels that we were seeing on Monday, but that's after we had already fallen significantly for the week. So let's talk about the CPI and the PPI reading, which both of them were there. So the CPI is the Consumer Price Index. You probably know about it by now. It's basically what the consumers are spending. It's a good indicator of inflation on the individual side, and it missed expectations. So both headline missed expectation and core missed expectation. And really, it was the core that was the scary part, because the hope was maybe we saw the peak of inflation back in March. Now, we actually did see core continue to come down, but not as much as we were hoping it would come down. And thus, there's still the thought, wait a minute, has inflation peaked? Is there still more to come? Then on Thursday, we had the PPI, which is the Producer Price Index. And again, a pretty scary miss. And it's basically saying that these supply chains are really bad. And everyone keeps hearing, hey, supply chains are bad. Supply chains are bad. No, they're really bad. And the Producer Price Index reiterated that of still the cost that it's taking way longer to restore these supply chains than they thought. But a really interesting piece that actually came out from the St. Louis Fed this week was these supply chains are taking a lot longer, but there's so much investment right now going into these supply chains that we're actually building a massive resiliency right now. Once we get through all this craziness, which it doesn't look like we're close to getting through it, it wouldn't be surprising to have way more operational efficiency than ever before and some massive up-leveling because of that. And so it's really surprising to, at least I was surprised to hear that report, and really strong, maybe not again for the next 3 to 6 months, but actually a pretty strong sentiment for what this post-COVID, post-war, post-supply chain inflation era could look like.
I just want to tag on to that. If we think about this, since the 90s, China has been the main manufacturer for the world. the U.S. had in the 70s and 80s offshore a lot of its manufacturing, which means that our supply chain is based upon what's happening overseas much more than it used to be. And that's been going on for 40, 50 years now, and to China the past 30 years. China's been having a lot of problems with COVID and lockdowns, which is partly why the supply chain has been so bad due to the pandemic. And there's been this realization that maybe we've gone too far. And now we're seeing a rebound from that and a lot more investment to create resiliency in the supply chain. So this is really good on a go forward. But right now, it's extremely painful because it's not going to help us today.
Yeah, and I think another kind of scary part about where we are right now is the fact that the Fed, not only is the Fed raising rates, they're raising rates at one of the most hawkish paces in a long time. Again, we're not used to the Fed raising rates 50 basis points time and time again. In fact, usually what we see is one really big move of, back in the early 2000s, we saw a 75 basis point move and then 25, 25 over and over again. Back in the 90s, we saw a 1% move, so 100 basis points, and then 25, 25, 25. So it's, if anything, we're almost seeing, 350 basis point move. It's not really normal for the market. And so in some ways, it's been one of the hardest times to own assets. The other, I guess, potential, side of it too, and this is why, again, the market keeps seeing all this volatility in both sides, is the other thing that the market hates is uncertainty. And I think we've had a lot of uncertainty. And, why was the market up on Friday? One very possible conclusion is no one wanted to buy before the CPI reading because everyone was nervous that it was going to miss. It did miss. We sold off more. And then people might have started saying, well, all the bad news is out there. We don't have another catalyst event for another 3 weeks. Maybe it's a time to get back into the market. The bad news is kind of behind us. We know what the Fed's going to do. They're going to keep raising rates by 50 basis points. They've given us the game plan. Maybe I'm willing to get back into the market right now. And so we could be seeing a recovery in that end. And if that is the theme, it wouldn't be surprising if maybe Wednesday, Thursday, we saw one of a localized bottom. But again, another possible situation is we get more bad news and then we see another market fear, sell off. And again, it's going to keep coming back to, we're seeing a lot of volatility, a lot of really plausible positions that the market could move in rapidly. And it makes it really hard to have full clarity.
Yes, and we have so much going on that it's hard to determine whether it's all good or not, whether the move up that we've had today, the bounce that Knight's talking about today, was just we've had so much downward movement, people are bargain hunting, or whether, as he said, this is indicative of a more long-term. It's been about 40 years since we've had interest rates going up at rates like this. So there's not a lot of big memory as to what's happening with many of the institutions as baby boomers have been retiring in large groups. So it's been a while since we've seen this. And the last time it was a huge inflationary period and a hollowing out of our manufacturing, which is not what's happening now, but there's a lot of uncertainty as to what does this really mean.
Yeah, and I think, most importantly, as we always say, these are things that we're looking at. If you're nervous right now, talk to us. We want to hear from you. we're thinking about this, we're willing to talk with anyone about what's going on, you're okay. And it's something that when things are so stressful in the market, sometimes we go to the worst position of future fearing. And if possible, if you're feeling that future fear, give us a call. We'll talk around your unique situation with you. But if you're not feeling that future fear, or if you don't feel like you need to call us, another great option is to just be where you are today. It's a beautiful day outside right now. And I know it sounds silly, but I'm looking forward to just walking around the pond later. And sometimes realizing that life is so much more than just money. It's so much more than all what's going on in the stock market can really be helpful and grounding if you're feeling the intensity of it. So that's just a quick little aside. But as always, we're here to support you. Your money's here to support you. And we'll see you again next week.